Welcome to Module 5, Trading Strategies. By the end of this session, you will be able to identify high-probability breakout patterns, interpret key technical indicators like moving averages and the relative strength index, and apply psychological frameworks to manage greed and fear in your trading. We are moving from theory into execution. Trading isn't just about clicking buttons. It's about having a repeatable plan. Let's start with one of the most popular ways to enter the market, the breakout. First, let's talk about price action, specifically breakout strategies. A breakout occurs when the price of an asset moves above a resistance level or below a support level with increased volume. Imagine the price is trapped in a box. It hits the ceiling, which we call resistance, and the floor, which we call support. When the price finally punches through that ceiling, it signals that the buyers have overwhelmed the sellers. This is your signal that a new trend might be starting. A key secret for beginners: look for high volume. If the price breaks the line but nobody is trading, it might be a fake out. We want to see a surge of activity to confirm the move is real. Notice how the price often comes back to touch the line it just broke? This is called a retest. In trading, we say old resistance becomes new support. This retest is often a safer entry point than chasing the initial jump. Next, we are going to add some tools to our belt to help confirm what the price is telling us. These are called technical indicators. Specifically, we will look at the Exponential Moving Average, or EMA, and the Relative Strength Index, or RSI. A moving average smooths out price data to create a single flowing line, making it easier to identify the trend direction. The Exponential Moving Average is special because it places more weight on recent price data. This means it reacts faster to new information than a simple moving average. When the shorter-term EMA is above the longer-term EMA, it suggests an uptrend. When the price stays above these lines, the EMAs act as dynamic support, pushing the price higher. Now look at the bottom of the screen. This is the RSI. It measures the speed and change of price movements on a scale from 0 to 100. Generally, if the RSI is above 70, the asset is considered overbought, meaning it might be due for a pullback. If it is below 30, it is oversold, suggesting it might be ready to bounce back up. A pro tip: don't use these in isolation. If you see a breakout on the chart and the EMAs are crossing upward, you have a much stronger signal. Now that we have the tools, let's walk through a real-world example of how to combine them. Imagine we are watching a stock that has been stuck between $100 and $105 for several days. First, we see the price break above the $105 resistance level. This is our breakout. Next, we look at our EMAs. The 9-period line crosses above the 21-period line right as the breakout happens. This confirms the momentum is shifting upward. Finally, we check the RSI. It is at 60. This is perfect. It's strong, but not yet over 70, so it's not overbought yet. There is still room to grow. In this scenario, a trader might enter at $107. To manage risk, they would place a stop loss just below the old resistance, perhaps at $104. If the price falls back into the box, the trade is invalidated and we exit to protect our capital. Take a moment to think. Why wouldn't we enter if the RSI was already at 85? Exactly. Even with a breakout, an RSI that high suggests the rubber band is stretched too far and a snapback is likely. We want to catch the move early, not at the end. Even the best strategy in the world will fail if you cannot control your own mind. This brings us to the most difficult part of trading: the psychology. In the classroom, trading looks like math. In the real market, trading feels like an emotional roller coaster. Most beginner failures are not due to bad indicators. They are due to the twin giants of fear and greed. Let's look at the cycle of emotion. Let's look at greed first. Greed manifests as FOMO, or the fear of missing out. When you see a price skyrocketing, greed whispers that you should double your position size or enter late without a plan. This usually leads to buying at the very top, just before the smart money starts selling. Then there is fear. Fear makes you hesitate to take a perfect setup because you had a loss yesterday, or it makes you panic and close a winning trade too early. because you are afraid the profit will disappear. The professional trader views a loss as a business expense, not a personal failure. To handle these emotions, you must rely on your trading plan. If the plan says exit at X, you exit at X, regardless of how you feel. Take a second to be honest with yourself. How would you react to a 2% loss? Would you try to revenge trade to get it back immediately? If your heart is racing while you are in a trade, your position size is likely too big. Lower the stakes until the numbers on the screen do not trigger a physical stress response. To ensure these concepts stick, let's analyze a failed breakout to see how psychology and indicators work together to protect you. Look at this chart. The price broke resistance, which usually signals a buy. However, notice two warning signs. First, the candle didn't close strongly above the line. It left a long wick, showing that sellers pushed the price back down immediately. Second, look at the RSI. It was at 82. The market was overextended. A beginner driven by greed would see the price moving and jump in blindly, fearing they'll miss a moonshot. A disciplined trader would see the overbought RSI and the weak candle close and say, "I'll wait for a retest or a better setup." If you did enter, your stop loss, that safety net we discussed, would have closed your trade automatically with a small, manageable loss. Without that plan, fear might cause you to hold and hope as the price drops further, turning a small mistake into a catastrophe. Success is not about being right 100% of the time. It is about losing small when you are wrong. Remember, even a 50% win rate can make you wealthy if your wins are larger than your losses. Discipline is the bridge between a strategy and a profit. We have covered a lot of ground today, moving from the mechanics of price action to the internal discipline of the trader. Let's recap our journey through Module 5. We covered identifying breakouts and retests, using EMA and RSI for confirmation, and managing emotions with a trading plan. First, we learned that a breakout is not just a line on a chart. It is a shift in the balance of power between buyers and sellers. We looked for volume to confirm that move and realized that waiting for a retest can often provide a higher probability entry. Next, we integrated technical indicators. We used the Exponential Moving Average to identify the trend and provide dynamic support. We used the Relative Strength Index to ensure we aren't buying when the market is exhausted or overbought. These tools act as our filters, helping us say no to bad trades so we can say yes to the best ones. Finally, we addressed the human element. We recognized that greed leads to chasing and over-leveraging, while fear leads to hesitation and panic. By using a predefined trading plan and a stop loss, we take the emotion out of the equation. Trading is a marathon, not a sprint. Your next step is to open a demo account and practice identifying these patterns without risking real money. Look for 10 breakouts, observe the RSI, and see how the EMAs behave. Consistency is born from practice. Once you can execute the strategy without your emotions getting in the way, you are well on your way to becoming a professional. I will see you in the next module, where we will discuss risk management in even greater detail.